What is up, everybody? This is Stock Market Education, and today we're going to be talking about the top 3 growth stocks to buy for 2020. Let's get into it. Growth investing is a style of investing, my favorite style of investing, that focuses on capital appreciation and shows signs for above average growth. The catch is that you're going to be investing in companies that are sold at a premium price when you're looking at common metrics like PE ratios and price to book ratios. Growth investing is my favorite way to invest because growth stocks have the highest returns of any investing style that I've seen. Take Netflix, for example. About 10 years ago, Netflix was trading at about $15 a share, and now Netflix is over $400 a share. Pretty impressive. Or we could take a look at Apple, whose stock price was around $35 a share a decade ago, and now Apple has 10x'd in the past decade. And the beautiful thing about buying individual stocks is that you don't have to bet on every stock to be a home run. You can pick and choose the companies that you know really well and double down on the most compelling growth strategies, and the longer you hold on to a stock, the less you have to share your profits with the IRS as well. Here are all the positions I have in my portfolio, along with the percentage portion of the portfolio each one takes up. As you can see, I'm very cash heavy because I'm quite skeptical about the market's price recently. Let me know in the comment section down below which stocks you own in your portfolio. Before we get into this video, make sure to smash that like button and subscribe for more content on the stock market. With that being said, let's get into it. So the first growth stock on the list is Amazon. With over 750,000 employees, Amazon is one of the largest companies in the world for cloud computing with their Amazon Web Services that had a 7-year head start on cloud computing software, along with online retail, the largest online retailer in the world, and artificial intelligence and digital streaming. The past year-to-date performance compared to the markets was up almost 39%, and compared to XLK, the tech sector of the S&P 500, Amazon is up 30.55%. And that's because Amazon has some of the largest revenue streams in modern history. If we look here, we can see that Amazon earns $232 billion a year, which means that they make about $7,300 every second. These types of gains illustrates how lucrative Amazon has been. If we look at earnings, we can see that out of 47 analysts, they're averaging earnings of 21.6. I'd say that's pretty fair for Amazon. Could be a little higher in my opinion, and next year they're expected to do $38.22 a share for a 77% increase, which is absolutely incredible for a company with a $1.2 trillion market cap. Unbelievable. The next growth stock to look at is Tesla. If we look at the top of the financial summary, we can see that Tesla recorded $5.1 billion in the most recent quarter, which is down from the prior quarter. However, it is still in line with automotive revenues from Q3 of 2019. And if we go down to EBITDA, we can see that Tesla recorded $951 million in EBITDA, which is up 514% year over year. So although the trends in the short term are hard to determine, the long-term trends are very noticeable. Some bad things about the financial highlights for Tesla are that they turned negative for the first time since Q1 of 2019, and free cash flows turned to negative $895 million. However, Tesla has been able to raise money in the past with no problem, so they should be able to raise more money in the future. Tesla also made some promising forward-looking statements like, "We have sufficient liquidity. We believe we will achieve industry-leading operating margins and profitability." And this paragraph is the most important paragraph because it talks about how Tesla plans to become the industry leader in operating margins. It says, "We expect that production of both Model Y and Fremont in Model 3 in Shanghai will continue to ramp gradually through Q2. We are continuing to build capacity for Model Y in Gigafactory Berlin and Gigafactory Shanghai and remain on track to start deliveries from both locations in 2021. Lastly, we are shifting our Tesla semi-deliveries to 2021. The third and final growth stock to look at is Revolve. Revolve is an online clothing store in a sense, and Revolve has a disrupting business model because they created trend forecasting algorithms to be able to predict future trends in fashion. And now with giant clothing stores like JCPenney filing for bankruptcy, it opens up the markets as an opportunity for new players to come into the space, and Revolve has the business theme of growing into fast-growing trends. If we look at income statement highlights, we can see that their numbers have been impacted in Q1 of 2020, mostly because savings has gone up and every single music festival has been canceled. And one of Revolve's main ways to advertise their products is through social media influencers with hundreds of thousands if not millions of followers. And with many music festivals closing, influencers can't take pictures with Revolve's clothing and advertise them to their followers, and Revolve has been hit hard during this time. However, their net income is still positive with 6% year over year. Gross margins is down 290 basis points, net income is down 16% year over year, and EBITDA is down 34% year over year. However, when you look at active customers, their amount of customers for Q1 2020 was 21% higher than Q1 of 2019, and their total orders placed and average order value remained flat. I think that total orders placed is going to double or triple in the next 5 years because of their unique business model that is online and liquid. Looking at more strategies from Revolve, they've protected their balance sheet. For instance, they reduced capital expenditure by delaying or canceling projects, and in addition, it's important to note that they drew down $30 million from a line of credit. A line of credit is good for the short term because it strengthens a company's position in cash. However, long term can be a little more complicated because Revolve has to pay that money back along with interest. And keep in mind, interest rates are among the lowest rates in US history. However, they still have to pay some type of interest nevertheless. Amazon, Tesla, and Revolve are interesting growth stocks to consider, although you have to take into account that the stock market is grossly overvalued at these current levels. Hedge fund titan David Tepper says that the stock market is the second most overvalued he's ever seen. And David Tepper is an important hedge fund manager to follow because he's one of the most successful hedge fund managers in the world, and his comment about the stock market tends to dictate the stock market in the short term. And many people would agree that stocks have drifted too high up. Sometimes prices don't move up or down for any logical reason, something that is hard for the beginning investor to wrap their mind around. Thank you guys for watching the video. Be sure to click the like button and subscribe if you enjoyed this video, and have a great day. Bye.